You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means we're back for Interview Tuesday. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you, wherever you hear this program, live, after the fact, keep those ratings and those reviews and those comments coming. It really does help new folks continue to discover the content in these troubled times. Keep those questions coming, too. We do love to hear from you guys. Let's see who we're hearing from on the old Options Insider Radio program today. I am pleased to be joined by an old friend of the program, Mr. Jim Toes, the president and CEO over there at the Securities Traders Association. Jim, welcome back to the Options Insider Radio program for the first time here in 2021, sir.
Thank you, Mark. Thanks. Great to be back. Happy belated New Year.
Yes, thank you. It's been a quiet year so far, right? Not really a lot to talk about so far. We should probably just hang up now. What do you think?
Yeah, I almost slept through it so far.
All right, well, let's get into it. Let's actually start. You guys put out a newsletter on a regular basis to the industry, your STA newsletter. And the title of your newsletter for last week, Jim, was Not Our Finest Week. I think I can empathize with that a little bit. Why don't you explain to our listeners a little bit about what you meant?
Yeah, I mean, it wasn't our industry's finest week. If we just kind of have an honest conversation and be candid about it, right? And there were, several factors why I think it started off kind of ugly and just got uglier as the week went on. And it really was like what we mentioned, and it said, really what investors needed last week was, leadership, education, and facts, right? And unfortunately, all three were in short supply. And I think where the first part where we saw that short supply was the unfortunate timing that this took place during a transition in the White House, where, we have an acting SEC chair. We don't have, the Gary Gensler, his nomination has not been approved yet. So, that and along with some other factors, just created this vacuum that, that political leaders love to step into. So, you get folks like Ted Cruz and Elizabeth Warren out there and just, adding to the chaos that was going on. So it was kind of painful to watch it play out. And it wasn't just on the regulatory and legislative congressional side. I kind of think that maybe if we had Jim Cramer at the helm last week, maybe that would have helped us smooth some things out. He obviously understands this space very well. But it just wasn't our finest week.
Well, let's get into that. Obviously, a lot to unpack here with the world of GameStop. We'll get into the messaging and all that fun in a little bit, but it seems like, Jim, a lot of the consternation, a lot of the confusion from this has stemmed, and we've certainly been inundated with questions about this. I'm sure you guys have as well. It stems from the fact that GameStop, at the time all this kicked off, was shorted well north of its actual float, somewhere around 150%. So a lot of people are asking why and how that was able to come to pass. Of course, there have been regulations in the past, and usually I don't like to go deep into the regulatory morass, but given the fact of what's going on right now, you probably have to, Jim. So Reg Show, of course, talks about how these shares are supposed to actually be able to be located in some sort of reliable time frame. So it should make sense. You think people would think that it should line up to not exceed the 100% threshold. So walk us through, to the best of your understanding, Jim, how did that come to pass? How did GameStop, how were they able to amass 150% short interest in that name, sir?
Yeah. So first off, listen, if you gave me a test 2 weeks ago, I would have said it's impossible to have a short position in the industry, of course, aggregate, that is greater than the number of shares that are outstanding in it. And by the way, it was 140% of the shares outstanding. It was even a much larger percentage of the float, right? So it was a significant short position, and I did not think that could be possible. But to your point, listen, what happens sometimes is that securities get lent to one entity who is shorting the stock. The person who is purchasing it may be lending the same security to another entity who is shorting the stock, and that relending of the same security obviously leads to the possibility of what we saw, which was a short position that was greater than the number of shares that are outstanding on it. We don't really see a lot of these positions out there, right? I mean, I think it's not like we have 150 securities out there with short positions that are like this. But as we've seen in the past, Mark, is like sometimes, when we get like one instance of like of a systemic failure or something going wrong, that does so much damage to investor confidence, even if it happens just once every, 100 years or 20 years, although I feel like we're having 100-year floods now every 6 months. But, those things really do damage investor confidence more so than like some of these nuanced things that we talk about on a regular basis in market structure. So I think that is going to be it's going to be an area that the commission and, that looks into. Obviously, there has always been a reluctance to have short positions reported, under Form 13F, where accounts have to report their long positions, at the end of the quarter. The shorts are exempt from that. They don't have short positions being reported, so that may have contributed to it. Another contributing factor may have been that with the way the clearing goes, that all the stock is being held in street name. No one really knows who owns which shares out there on some of these stocks. So it's going to have to be looked at. It is definitely one of the inefficiencies in the marketplace that this event has flushed out that will be looked at in a lot of detail.
It seems like every decade or so, Jim, we have one of these comeuppances that causes a great moral panic about short selling. We had one around 2008 or so. So it happens probably around the .com meltdown as well. So I guess we were overdue in that hindsight there, Jim, for the next big panic about short selling. Who knew it would come around GameStop? But that's the world we live in right now. As you mentioned, we're getting these 100-year floods every 6 months, or probably even every month at this point out here. I've heard some other people pointing fingers at the market maker and specialist exemption out there for short selling. Obviously, these market makers are out there hedging their position, so doing their regular function that is demanded of them by the business. So nothing nefarious going on, but just a regular part of day to day that also maybe contributed. Is that what you're hearing as well, Jim?
I mean, I haven't heard that specifically. I mean, but I don't think a lot of these market makers are really carrying positions overnight. And even though they have the short exemption, they don't really have it forever. I mean, at some point, they have to cover as well. So, I'm sure it played a contributing factor into it, but I wouldn't necessarily say it was like the primary one as far as the oxygen that fueled what we saw last week.
I think a lot of options participants will be relieved to hear you say that. You mentioned this wasn't the finest week for the securities industry. I'm curious for you, are you dismayed by just the legion of conspiracy theories that have erupted? As you mentioned, there was a bit of a vacuum of information and facts, and certainly clear messaging from the brokers last week. So in a vacuum, these new theories are going to abound. Have you been dismayed, as I have, by seeing the rise of this? It was the Citadels, it was Melvin, pick your name and insert it in there. It was all of them pulling strings behind the scenes that led to all of this, Jim.
Yeah, I know. All the conspiracy theories, the demonization of hedge funds, short selling is un-American, and so on. I mean, listen, I think our markets, it is frustrating to see that play out on TV or play out anywhere in the public domain. And the frustrating part, obviously, is just knowing that the response time from the people who can kind of be a counter force to that, in particular, the regulators, the SEC, knowing that they were kind of in a vulnerable position here, waiting for the next chairman to come in, that their response time is going to be a little bit slower. It was frustrating, but on the other hand, it's a short-term phenomenon, right? We will have a chairman soon. There will be hearings being held at both the Senate and the House on this. And, we will get the information that we need, which, by the way, I think is the number one thing that everyone needs right now, right? We've had to, I think, first of all, we need to realize that this was like a pinnacle moment in our market evolution. I think we need to decouple the things that are specific just to Robinhood, and then things that are really systemically inefficient across our marketplace, and then look to try and find some solutions to them. But first and foremost, really, I mean, listen, the commissions, they got to get out there. They have to start doing their investigations, which they are, and they got to start gathering data so we can start having intelligent conversations. Because once the intelligent conversations have, then all those conspiracy theory nuts and stuff, they tend to go, they go away.
Obviously, the regulators need to do their job, and we need to have regulators appointed. On the other end, the broker-dealers kind of dropped the ball last week as well. We saw mixed messages coming out of all of them. We're not banning things. Oh, yes, we are banning things. Or we're just adjusting margin. There was a lot of miscommunication or just a lack of communication from a lot of brokers who seemed, for some participants, to be out there kind of just changing the rules willy-nilly. We won't even get into the Robinhood and all the other madness that unfolded there. Just a lot of the traditional broker-dealers in the space had similar messaging issues. Do you think maybe going forward, STA, this is something you guys need to address? Maybe get the industry together and say, hey, look, in these types of environments, we need to have clear messaging, some sort of clear communication, maybe ahead of time. That would be nice. Here's the rules we have. Here's the things that we could change. Not to have this ham-fisted make-it-up-as-we-go approach that seemed to really just muddle things even more, Jim.
Yeah, no, I mean, it did give the appearance that, that rules and decisions were being made up on the fly, right? And that never plays out well when you're in a borderline chaotic crisis situation like we were going through last week. So that certainly did not contribute to it. And by the way, you bring up a good point. I mean, obviously Robinhood is the one taking, a lot of the getting all the attention on this, but the issues that they dealt with around, the clearing deposit requirements, they weren't the only ones getting calls like that, right? And they weren't the only ones having to deal with those issues around, trying to, make sure that they were liquid and have their deposits in line with NSCC. So, again, we just wanted to kind of separate what was it going on at Robinhood versus what are some of the issues here with the greater industry.
Well, Jim, we have a poll out there live right now. Just went live right before our show. I have a feeling I know how you're going to vote in this poll, but I want to get your thoughts nonetheless. Our poll right now is, there have been many debacles that have left lasting impacts on the options market: the 87 crash, long-term capital management, the dot-com meltdown, the great financial crisis, just to name a few. Do you think we should add GameStop and the resulting frenzy to that list? Jim, I'm curious for you. Like I said, I think I know how you're going to vote, but what is your vote in that poll, sir?
Right now, I would say yes. I mean, I think it is. Listen, here's what as far as if the measurement that we're using is and the losses, then we're going to have to wait a little while. But I do think that it's going to be big enough in that area that it will make a list. Maybe not the top 5 list, but I'll tell you one thing, as far as investor losses, that I would not be shocked if this is greater than the flash crash of May 6th. So people talk a lot about the flash crash that happened May 6th, 2010, and think about what that led to, the hearings, the rules around, we got the consolidated audit trail. That was the gift of the flash crash that we've all gotten from that. But as far as on that day, the amount of investors who lost money really was not that much, right? The stocks, they dropped and they came right back up again. Trades were busted, and the everyday investor really did not suffer, catastrophic losses on that day. But yet we got an enormous amount of regulation and stuff, and on the back end. This is different. I do think that when this thing does settle down, there are going to be some major hits from investors on this, and maybe even some BDs on it. So I do think that it is worthy to be on the list, whether it's on the top 5 or top 10. Probably somewhere between 5 and 10.
Yeah, our audience agrees with you, Jim. They say we're living in a post GameStop world, 66%, so 2/3 agreeing with you so far here. Jim, the shame of all this is that this madness of GameStop here unfolding just in the last week or so has overshadowed what really should be a enormously positive trend for the options market and indeed the securities market in 2020, which is retail traders discovered these products en masse in 2020. If there was one positive takeaway to take from the tumult of a mad year that was 2020, is that a lot of call them what you will, the Robinhood traders, one-lot traders, small retail traders, whatever you want to call them, a lot of them discovered the world of options, Jim, last year to the tune of 7.5 billion contracts, blowing away the previous record by about 50%. Yet all of that is lost in this mad speculative frenzy that is GameStop. And I'm curious for you, Jim. You've been doing this for a long time. You've been overseeing STA for a long time. What are your thoughts on just the retail revolution that gripped the markets there in 2020, Jim?
Yeah, I mean, listen, it was great to see the engagement, right, with retail investors coming in, especially they were definitely new ones, right? And I think where we saw our market has always served retail investors, I think, well, right? Their ability for people to log on from their living room and open an account and trade directly into the marketplace, that's always been there. We've been serving that investor for a long time. But obviously, as you pointed out, I mean, what we saw in 2020 with, single lots, going up in options, these were definitely investors that were not participating in the markets in 2019 and early. So it was great to see that. It was great to see that that them come in that kind of size, and they obviously were getting. I believe they were getting a favorable experience. They had a nice wind at their back on it, and it was just so important. I think because listen, this was the doorway that they came into our marketplace, right? They were coming into our markets through options, right? For they don't want to have to buy a stock that's trading at $1,200 or $500. They just wanted to buy some calls on stocks that they really like to follow and stuff. And that is very important because we're talking about a generation of investors here. So I do think that we saw enough strength in that hopefully that what we saw this past week doesn't as you pointed out, turn off that whole generation of new investors that just kind of came into the marketplace. I mean, I guess, time will tell on that. But I do hope, I'm hopeful though that what we saw in 2020 is more what we're going to be seeing in 2021 versus what we saw, last week.
Well, if the volume numbers for January, which are just in from OCC, are any indication, at least so far, a lot of this obviously driven by GameStop, but they're not going away anytime soon. Over 800 million contracts hitting the tape. We're closing in, Jim. It's possible. It sounds crazy, but we are closing in on potentially having a 1 billion options contract month. Do you think we'd ever be saying that out loud in 2021, sir?
No.
Neither did I,
no.
Quite frankly.
No.
And yet that's kind of where we are. Well, let's step away from the madness for a second. I know coming into 2021, everyone was hoping for a little bit quieter year. Doesn't seem like we're going to get that at least anytime soon, but I'm sure you had some issues and some items that were on your agenda for 2021 before everything got hijacked by GameStop. Maybe that agenda going to look a little bit different after the past week, but I'm curious, coming into this year, what were some of your agenda items? What were you guys planning to work on? What were the big ticket items for STA in 2021, sir?
I mean, listen, I think, coming to 2021, obviously, we have a change of administration in the White House, right? And that leads to, a fair amount of turnover down in DC. So I think our initiatives for January, February, the first quarter were, okay, let's try to get our arms wrapped around, who's serving on what committees, who's sitting in what seat at the SEC, and what are going to be some of the initiatives there. Like in a lot of ways, Mark, as far as like the issues that we work on, some of them are just in response to what, the regulators and the legislators are looking at. So that's one area. It's just like the first quarter, trying to get organized around who are some of the new players down here, especially on the staff side. I hate to say it, but I mean, the one thing that is going to definitely come up is going to be this financial transaction tax. That's all I'm going to say about it, and we'll move on to the next topic. But some of the other issues that are out there, we're doing stuff with FINRA. Obviously FINRA's got a report out there looking for input on just lessons from COVID and trying to put in a regulatory regime that is more supportive of work from home. And then the other area that we're going to be looking into is that there is around fixed income, but narrowing it down to the electronic trading platforms that trade corporates and munis. There's a lot to get done there. And I think our first initial step there is that we don't want to, I think we're just trying to make sure that, the equity market structure cookie cutter doesn't automatically just get placed on top of the fixed income markets, because it's obviously a much different marketplace than it is for equities.
And Jim, you guys obviously just came off of your big, usually here in Chicago. This year it was virtual. The STA Chicago event. We had Paul Giganti on recently talking about the options panel you guys had. It was a very optimistic, upbeat session, of course, until everything happened over the course of the past week. But I'm curious for you, any interesting takeaways from that event that you think would be interesting for our audience?
Well, we're just kind of happy. Like, listen, it would, as you know, Mark, listen, we have 20 affiliates in the U.S. and 4 in Canada, right? These affiliates are run by volunteers. It was a challenge for us at the national level to put on a virtual event, right? And it's a lot of work goes into it. We were just so happy and so proud of them that at the local level, they were able to put on such a successful event that they did. They had meaningful content. They had good participation. They had good engagement on it. I thought the speakers were fantastic. We had, Hester Peirce spoke, the crypto mom. She spoke she was interviewed. I thought she was fantastic. So I think really from where I sit, I think the thing that was most, impressed by was just the fact that, a bunch of volunteers at the stack level were able to get together and put together, a great event on, in an environment, in a forum that they normally don't do.
Well, you mentioned the magic word, that is crypto. Outside of GameStop, that's the other magic word, crypto, and indeed Bitcoin. I guess throw Tesla into there. You got all the hot ones these days, Jim. But I'm curious for you. I think coming into this year, I know in previous events at STA, you guys have done a lot of work to incorporate crypto into the events. Is this something you continue to foresee in 2021? You guys putting more emphasis on the Securities Association in all things crypto, Jim?
No, I think, listen, I got to tell you, we're going to take a little bit of a pivot actually away from that and focus more on the fixed income. And we just think that the crypto space, we did have in 2019, we had a fair amount of folks that were, whether they were in the equity space or the principal trading firm space, that were in the crypto space. So we were doing some work that we had, relationships with some folks that were historically, STA members that were in a different asset class. So those people now have kind of moved on. They've come back. They've kind of left the crypto space and they've come back. And now we have the fixed income that is coming up. And that is obviously, an enormous market that they're looking to do things that look and feel a lot like the equity market structure, ATSs, dark pools, whatever you want to call them. But they're doing stuff in that area that I think we can add more value when we have more touch points in it.
Interesting. Not what I expected, Jim. A pivot from crypto into all things fixed income. We'll keep an eye on that going forward. Unfortunately, that music means we've come to the end of our little sojourn here on Options Insider Radio, Jim. But before we go, we touched on a lot of initiatives you guys are working on over there at STA, but we like to leave our audience wanting more, Jim. So is there anything else you forgot to add you think may interest our audience? Or maybe you want to leave them a little bit of a hint, a little bit of a tease of what's coming down the pike from you guys over there at STA. Now is the time, sir. The floor is yours.
Just keep an eye out for an April event. All right. We're looking to do something in April. It'll be a Washington, D.C. spring update. Bring your pink cherry blossom ties and we'll see everybody in April.
There you go. In April. And Jim, if they want to learn more about these different events or the initiatives you guys are working on, where should they go? What should they do?
SecurityTraders.org. SecurityTraders.org. We're there.
There you go. SecurityTraders with an S.org. On behalf of Jim and everybody over there at STA and indeed myself, I want to thank all of you out there for downloading, streaming, for joining us live, for sending in your questions, for voting in our polls. Keep it coming. Of course, stay tuned throughout the rest of the week. A lot more content coming at you here on the Network Education Wednesday. Tomorrow, Options Bootcamp, Options Playbook Radio. Thursday, a double dose of TWIFO and the Option Block. Friday, volatility views. Then it all kicks off again next week with crypto and the Option Block, all the way through to another interview Tuesday and another episode of Options Insider Radio.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.